Hello, everyone, and welcome to Profiting from Earnings. I'm going to just hand it over to my good friend James, who will do a brief introduction.
Good evening, everyone. I hope you're all doing well. Just want to say on behalf of Macro Market Group, we're very excited about this 4-week workshop with Mandela. He's a pleasure to work with, but also a very experienced professional and profitable trader, which is the most important thing. And we're really looking forward to this 4-week workshop. It's at the same time, 5:30 p.m. every Tuesday for the next 4 weeks in February. And tonight, obviously, we've got a session all about profiting from earnings season, which is the perfect time considering that we're in peak earnings season with Alphabet and Amazon still to report this week. But just want to, like I said, thank you on behalf of Macro Markets Group to Mandela for hosting this over the next 4 weeks. And everyone that is watching, make sure that you listen carefully. If you've got any comments, put them in the comment box, because Mandela will spin back to the comments at the end and obviously try and do a little bit of a 5-minute Q&A. And other than that, everyone, enjoy the show, and hopefully we can see you and catch up in the community afterwards. But over to you, Mandela.
Thank you very much, James. I really enjoyed that warm welcome, and it's really a privilege and an honor to be able to present today. So I just want to say a special thank you to Macro Markets for coming up with this idea. So let's start off. We have a lot to cover. And the first thing is, I think quite a few of you, I'll do a full screen. You don't need to see my face. A few of you probably have never heard or seen me before. And for those of you who have not heard or seen me before, just a brief bio of who I am. So used to be a lawyer and then became head portfolio manager. My previous job was in the legal department of Athene Holding, and they are a subsidiary of Apollo Global Management, ticker symbol APO. Before Athene was bought by Apollo, their ticker symbol was ATH or ATH, like all-time high. But that's where I'm coming from. And I've been trading pretty much for the last 20 odd years, give or take, with 1 or 2 breaks in between. So the topic for today is earnings. What are earnings? Usually companies will intentionally reduce the expectations so that they can easily beat their earnings. Today, we're going to cover what exactly is a straddle, which is the strategy that we use, or the technique that we use. We're going to look at our earnings checklist, and then we'll provide some examples if we have some time at the end. And then, as James rightly said, please save your questions for the end, where we will be answering hopefully each and every one of your questions. So there is a live chat available that you can pop your questions in as we go so that you don't forget them. Now, I'm sure everybody has seen this at some point in their careers, especially those of you who have been trading for a while and who trade US stocks in particular. This is this week's calendar, and I know James does post these in the Macro Markets group amongst many other helpful pieces of information. So what we're going to do today is kind of dissect this in a way where we can, going forward, know what to look for and also what to stay away from. So for those of you who have traded earnings before, or in the email, you would have gotten a link to explaining what is options. This is basically the strategy that we use for trading options. And the goal here is for the price of the stock to move beyond break even. So if the break-even price here is 110, we would like for the stock price to go from 111 higher. And then inversely, if the break-even price on the downside is 90, then we want the price to go lower than 90. And what happens is, in between here is where we will not maximize our profits. We may be able to make a little something, but ultimately we will end up with a expense. And I don't use the word loss because loss is for losers. I am running a business, and if I do not make a profit, than I am having or incurring an expense. So this is the basic strategy that we're using. We're looking at the current price of the stock. We'll call this XYZ stock just to be easy. As long as the price of XYZ moves beyond the break-even point, then we'll be making money. So the money that we make from this option will pay for the loss of the other option. Let's take another deeper look into this. So the long straddle strategy is basically looking for, like we said, large enough moves. As long as the price of the option moves large enough, then that means that we will make money. We don't need to predict the future. All we need to know is, will there be a significant price change in the underlying asset after earnings? And we're going to get into a little bit more detail on how we determine that. But before we get there, let's look at an example just so that we can wrap our heads around this. So let's say you think that we're calling it stock XYZ. We don't know if the stock XYZ is going to go higher or lower. So we don't know if it's going to go up or down after earnings. But we do know that it's expected to move. Let's say it's expected to move more than 7%. So we don't know if it's going to be to the upside or the downside, but we do know it's going to move more than, or expected to move more than 7%. So we can say plus or minus 7%. What we'll do is we will, before the earnings announcement, we will buy a call option and we will spend $500 on the call option, and we will buy a put option and we'll spend $500 on the put. That gives us a total cost of $100,000. So going into earnings before the market closes, if it's a evening or a earnings announcement after the close, we'll buy this on the day of earnings. If it's an earnings announcement before the open, then we'll buy this the day before. And then what happens usually is we'll get a nice move in the stock XYZ. So let's say in this example, stock XYZ now is $111. So it's going from $100 when we purchased it to $111. Now, this is still an example here, but if stock XYZ is 111, that means that the call option that we purchased is now going to be worth $11. That's a profit of 1,100. However, we lost money on the put because it didn't go in the favor of the put, but we were okay with losing the $500 on the put. That gives us a net profit of $100. Now, some of you may say, well, that's not a lot of money. I can't live off of that. I don't like trading earnings because the profits aren't big enough. This is just an example of if the price of the stock went from 100 to 111. And we break it down here as well. So the put that we bought would be worthless. So that's a $500 loss. The call that we bought would be worth $11. Sorry, $11, which is a profit of 1,100. And then remember, we paid $500 for the cost of the call. And that would give us a net profit of 100. And a lot of earnings do end up not moving drastically. So they'll get close to the break-even point. You don't often see, if you take a random selection of 100 earnings, you won't see the majority of them more than 10% or 11% move on the day after earnings. So this is a reasonable reaction to earnings. And basically what we're looking for is, as long as the price moves beyond break even, then we will profit from the trade. Now let's go to another example here, which shows the price moving a little bit further. So instead of moving to $111, let's say stock XYZ moves to $150 in this example. Now you notice the difference is quite large. Let's walk through it. So the call option in this case will be now worth 50. That gives us a profit of 5,000. The put, as we know, is now worthless. And then to work it out, the put is worthless. The call is worth 5,000 minus the 500 of the capital that we paid for upfront, gives us a net profit of $4,000 profit in the same time period for the same stock if it moves to $150. All right, hopefully that makes a little bit of sense. This is the inverse. So if the stock price moves down instead of up, so in this example, it moved up $50 from 100 to 150. Let's say, for example, it moves down from 100 to $50. In this case, just like when it goes up, we will have one of the options that will make $5,000 in this instance because the price has moved lower. Now the put is worth $5,000. The call is worthless, and we have made 4,000 profit on that trade. The reason we've made 4,000 is because we made 5,000 on the put. We paid 500 for it up front, and the call expired worthless because the price moved down. XYZ moved down. All right. Remember, if you do have questions, please pop them in the live chat and I'll make sure we save some time at the end. I'm going to have to keep it moving because time is a ticking. This is a very helpful chart as well. So as we know, with long straddles and with earnings, we want to see the movers. We don't necessarily, and we'll come to the checklist in a minute, but we don't necessarily need to go too much into the fundamentals for a simple earnings trade. The key is that the price of the underlying stock moves significantly. So if we look at this, this is also produced by our friends at Earnings Whisper. This SLOT, we look at the options implied move. It's expected to move 71%. This is Thursday before the market open. The other thing we like to look at is how does this stock trade, or how has it traded in previous earnings? So the day after earnings, how has it moved? Usually this is a very big clue that the earnings algorithms and those traders who focus on earnings like to trade this after the earnings announcement. That's what we're looking for. What's the implied move? How has it moved? And usually this is based off of the last 4 quarters. They'll take an average of the previous 4 quarters. So we go through here and we can see a few names that we recognize, but I think this is not enough. This is helpful. It's sufficient. It's useful, but it's not sufficient. So what we like to do is we like to have a checklist. And in our checklist, we focus on the expected move. So when we talk about the expected move of a earnings announcement, this is always produced in the build-up and it's based off of the options pricing. We usually like to get, and excuse my handwriting, I'm using a mouse and my handwriting with a pencil is atrocious. So usually we like to get at least a 7% move, which we talked about before. That's a minimum requirement. And that also can change. It could be higher depending on the actual options premium. The average move, so over the last 4 quarters, we also like to have something more than 7 as well. So that's taking the previous 4 earnings and what have the earnings algorithms, the earnings traders, the quants that only trade earnings, how have they treated this over the last 4 earnings? The implied volatility is very key as well when we're looking at what is the expected price volatility. And we like to get an option with a less than 100% implied volatility. And sometimes what you'll have to do, instead of getting the option that expires this week, Friday, you may have to get the option that expires the following week or a month's time. Key levels. So we'll look at where are we in relation to the all-time high as an example. So are we just below the all-time high to the point where we could push through it perhaps after earnings? Are we near some sort of key support level that we've been holding for the last 6 months? this is another factor that we bake into our decision. Are we going to do earnings? Yes. Or are we not going to do earnings on that play? This is what we're trying to decide. We like to go with big market cap. That's just a general rule. I find if we go with mid cap or smaller capitalized companies, it tends to be a lot more unpredictable, and they could have a large short interest. There could be some really unfavorable surprise moves. So this helps with the increasing the probability of success. Short interest is also a good one. If there is a large amount of short interest, there tends to be a bit of a higher probability that earnings does shoot through some of that short interest. Any announcements, so any products coming out, are they announcing any changes in the management? These are things that we like to look for. Insider transactions is also one. I have a slide on that. So are the directors, are the actual management of the company selling or buying? Analyst upgrades is also a good one. I tend to use a lesser weighting for this, but it is good to know. For example, Palantir today got at least 2 or 3 upgrades this morning after its earnings. And then the last one is government policy. So if Trump the White House administration is coming out with some policies that are favorable to the particular stock around the time of earnings, then that's also something to be aware of. Okay, and then I got a lot of questions from people in a form. I read everybody's form, and there was a theme that kept referring to earnings risk management. So this is the risk management aspect of earnings, and this keeps you alive for the long term. Earnings is risky, and I wouldn't disagree with anybody who says earnings are extremely risky, but this will keep you alive through any week of earnings. It's not going to hurt you. So just to start off here, I don't use the word loss. It's an expense. So the maximum expense on any earnings trade is always going to be less than 1%, ideally a lot less than 1%, so 0.7, 0.8%. So worst case scenario is that we lose 0.8% if that earnings trade doesn't work. The max weekly expense is 4%. So basically 4 trades at 1%. Or any combination. Our goal for the week, and this is only during the heat and the height of earnings season, is to try and do the best 1 or 2 earnings per week and keep it to that. There are a few weeks during earnings season, I believe next week might be one of them, where you get about 40% of the S&P reporting in 1 week. And in those cases, we are willing to do a maximum of 3, but no more. And this keeps you safe. Remember, we want to manage our risks. Size for 0 means we're okay if our option goes to 0. That's why we buy the option at the price that we do, because if it does go to 0, it will be within our maximum expense for the trade. And then during the trade, you want to minimize your risk at the outset by sizing for 0, keeping your expenses for that trade at -1. And then reduce your risk. So once you do get a favorable move, we want to move our stop loss to break even and protect our capital. Once the trade starts moving in your favor, we want to try and trail our stop loss. And ideally, if we can let the trade run for a little while, then we will. Earnings should complement your portfolio. The worst case scenario is a maximum 4% weekly earnings expense. So if we're talking about a $100,000 account, then your maximum expense here is going to be $100 per trade, and your weekly is going to be $400. You can afford to have 3 or 4 bad earnings weeks because you've exercised risk management. All right, next up we have Palantir. I'm going to quickly go through this. So the expected move was for a 9.6%. We produce these for each and every earnings that we shortlist. This is our second rank for this week, and it was Monday, so yesterday, last night. We look at the last earnings, we look at the average move, and then it was increasing its revenue here from 827 million up to 1.18 billion over the last 4 earnings. All-time high is all the way up at 207, and we were at 146 yesterday. And they have key partnerships with the government. So this is kind of like our earnings card. It takes out a lot of the noise, and we only focus on, like we said, the top 3 for the week. All right, this is just a quick idea of insiders buying and selling. So we can see here there was a lot of selling, especially this year. So January 2nd, first business day of the year. There was some selling of some directors and some officers, just a factor to consider. And then also we look at the upgrades. So we got some upgrades for outperform from neutral to buy. I didn't actually update this today, so there's probably a few more upgrades as well. And this was the move. So remember we talked about the expected move. The expected move was for a move of 9.6% based off of options pricing. And guess what? We were up almost 12% in pre-market this morning. So it does work. The strategy does work. We are looking for the big movers and the big shakers, but we're very, very, very selective of how many we do. And we like to filter out to the point where we're only going for the best of the best of the best. All right, I'm not going to talk about the Palantir trade because it's still rolling, but I will talk about Intel. So Intel reported earnings 22nd of Jan. That was a Thursday, and we were looking at Intel as a possible earnings position. So the expected move was for 8.7%. We saw that the previous month it didn't move much at all, only 0.3, but the July earnings, it was down 8.5%, and April earnings, it was down 6.7. So it kind of tickled our fancy a little bit. We were kind of like, okay, 8.7 is good. The average over the last 4 quarters has been more than 8.2%. So we went for it. How did we do it? So we got a put, and we used $238 of capital. We got a call, and we used $253 of capital. So together, we were willing to risk $491. Worst case scenario, we would come away losing, or I'd say the expense for this trade would have been about $500, and we were willing to eat that. What happened with Intel? So they came out with earnings. This was the official report. You can also listen to the earnings calls. The 2 main headlines are usually, and this is usually also produced by various news sources, the earnings per share and the revenue. For the earnings per share, let's do it this way. The expectation or the forecast was for 0.8 cents, and it was better, so 0.15. The revenue was expected to be 13.41 billion, and it was slightly better, 13.7 billion. And so better revenue, better earnings per share. Let's see. The other thing that we like to watch is the earnings call itself. So anybody interested, we were provided with this full earnings call checklist. And if you'd like a copy, please let me know. It just gives you a little bit more detailed information about what to listen for during the earnings call. What doesn't get a lot of press is the outlook. So the outlook for next quarter is always one I think that the keen traders and the keen investors like to look for. What is the expectation looking forward? And sometimes it's referred to as forward guidance. So we got the announcement, and what happens? Intel stock plunges 13% on soft guidance, womp womp, and concerns about chip production. And the price went down 12%. So our positions, how did we do? We had the put. And remember, we bought this put, and the put was actually up $387. So we bought the put here, and we ended up selling it the next day right at the open. So we bought it for $2.38, sold it for $6.28, profit of $387. Now for the call, we bought it here. It went down, and it expired worthless. So we bought it for $2.53. Expired, it was worth $0. So we lost $254 on it if you include commissions. And that was an expense of $254. So we made money on the put, we lost money on the call. And just a reminder, we were willing to lose or have a $491 expense on the trade. And ta-da, lost 254, gained 387. So net profit on the trade was 133. So we actually did this trade. And I just wanted to show you, a few good earnings trades added up can really, really make a difference. I think that's about it. I'm going to pause here and see if we have any questions. I do have a few other examples, but I'm going to open it up now because I'm running a bit over time. Let's get to the questions, I think, if there are any. If there aren't any, then we can continue on with some more examples. Let's pop. James, did you want to be on, or you're good?
I don't mind. I think there's a question from Matthew.
Okay.
I'm
Let's
not
see.
sure if you can see it.
Yeah, I got it there. So thank you very much for your question, Matthew. Why implied volatility below 100%? That's a very good question. Here we go. Okay, so he's asked a question and then reworded it. So really, really, really great question, Matthew. So the way that the implied volatility works, especially during the earnings announcement, is the market makers are building in a large move, a very volatile move upon earnings. If you do have an option with an implied volatility greater than 100%, then what usually happens is when the price of the option moves, it doesn't move to the same degree as the underlying. So for example, with NVIDIA earnings, NVIDIA implied volatility, if it expires that week, it's usually around 150 to 200% implied volatility. If you buy an option, let's say you buy an option for $500 for NVIDIA, let's say NVIDIA moves 8 or 9% after earnings. That option that you bought is not going to move at all. So you're not going to see the price change in the option reflected in your options price. Despite the fact that the underlying has moved 8%, your option price is probably going to move 1% or 2%. So if you go further out into the future, you can get an options contract that is closer to 90% or 80%. And that means that that particular option contract is going to move closer to the underlying stock. And that's the reason. But it's a really great question. It's something that I just kind of discovered over the last 6 months, 7 months, because I used to trade NVIDIA and I would have my options move in my favor. The price would move up and my option price would not move at all. And some people refer to it as a theta burn or a time decay burn or IV crush, implied volatility crush, where you're not seeing any moves in the option price because the option market makers have already built in the fact that there's going to be a lot of people wanting to benefit from a big move. Good question.
I've got a quick question for you, Mandela. I know last night, or I believe last night, obviously you was looking at Palantir on their earnings. Yeah. What other earnings coming out this week are you looking at? I know we've got Alphabet tomorrow and I think Amazon Thursday after the close. So what's the ones on your eyes and on your kind of potential trade list for this week?
That's a very, very good question. So the biggest one for this week, and this is based off of the criteria that we spoke about. You're welcome, Matthew. And if you want to talk about it more, we can do. It's hard to explain it in 2 minutes, but thank you again for your question. So James, the one that is number one on my list this week, ranked number one, is SMCI. The reason is it's expected to move 17%. Last earnings, it's moved down 11%. And average earnings has been around 12% move. Interestingly, the last 4 earnings have all been down. So the move the day after earnings has always been down for the last 4 quarters. And yeah, this is the one that I'm looking forward to the most. If we go back, let's see if we have, this is my actual table that I produce. So these are the top 8 or 9, whatever number that is. So ranked number one is also Iron. They do AI. and that's going to be on Thursday after the close. Expected move is close to 20%. So yeah, for this week, SMCI and iron. That's what I'm looking at. But
Nice.
yeah, very good question. I'm trying not to do all of them. I thought strategy may have surprised because of everything that's happening with Bitcoin. But I think if I go for more than 3, that's when trouble starts. So I have to keep it to my 2 or 3 max.
You got to stick to the strategy. But
yeah,
thank you very much, obviously, for hosting this tonight. It's been very insightful and definitely taught me quite a lot about how to trade earnings season as well. I think if you have time, one more question has just come through. But then other than that, I will hand it over to you to obviously kind of do the outro. But thank you to everyone for joining. And as I said at the start, we'll be back here every Tuesday at 5:30 p.m. throughout February. But yeah, there's one last question just popped up.
Yeah, I'll take that. Thank you, James. If you need to pop off, thank you very much as well to you and the macro markets team. Really appreciate it. So the question is from Nora. So as we try to estimate how much the option will be worth given a move in the underlying, which option pricing model works best in practice? So I go back to my slide where I'm looking at a long straddle and I'm looking for an option premium that is going to be within my risk limits. And I can pull that up one more time so that we can have a quick look at it. So yeah, the long straddle is the strategy. And then what I'm looking for is if it doesn't fall within 1% of my account capital, so taking the total capital in that trading account, if it's going to be more than 1% for an option priced near the money, then I will not trade it. And I'm happy to walk away. There was a few last week that I didn't trade just for that reason. At the money was like $7,000 or $20,000 at the money. And so I decided not to go for it because ultimately that's how you blow up your account. So this one, for example, STX, I just put crazy expensive. So I'm looking for something within that sort of risk limit. And if it does fit within it, then I'm willing to do a long straddle. And let the odds play out in my favor. Thank you very much, Nora. Thank you for your question. And thanks everybody for attending. James, thank you also for the lovely intro and for facilitating these.
No worries. Thank you for hosting. And like I said, we'll catch you all here next week at 5:30 p.m. for episode 2, which is about how to apply COT reports to your trading toolbox, which I think is going to be a very interesting one as well. So I'm really looking forward to that as well. Thank you very much, Mandela. Enjoy the rest of your evening, everyone.